And last but not least, I'd like to welcome up Erin, who will be presenting on the work that her group has done on behalf of Now City Communities under Maria Gray.
Hi, everyone. Thank you for sticking around tonight. I promise I won't be taking up too much more of your time. My name is Erin Quinn, and I'm here to present my team's capstone on catalyzing the development of sustainable real estate with impact investing on behalf of our client, Urban Reboot. Before we get started tonight, I'd like to thank my project advisor, Maria Gray, my fellow project manager, Michaela Lesnow, and the rest of my team for their hard work throughout the entirety of the semester. For our agenda, we're going to start by going over our client, Urban Reboot, talking about the problems they aim to solve, our methodology for helping them solve those problems, the deliverables we presented for them, and the next steps for our client. So our client, Urban Reboot, is a newly established nonprofit organization that aims to fund sustainable mixed-use real estate development projects. For the purpose of this presentation, we define a mixed-use sustainable real estate as real estate that has various programming types such as residential, commercial, recreational, and cultural spaces, all coupled with the intention of creating a positive, sustainable, economic, and social benefits. So Urban Reboot exists to solve a handful of problems in the construction and financing of real estate. First, real estate makes up 40% of global greenhouse gas emissions. Second, there's $5.2 trillion needed in investment to decarbonize the built environment. And finally, there's expected to be a 70% supply gap in sustainable buildings by 2030. To solve these problems, Urban Reboot segments its business into two streams. The first is impact investing, working to fund these projects, and the second is capacity building to ensure these projects get completed. Our capstone focused on helping Urban Reboot build their impact investing strategy. So we did this by breaking our team up into 3 working groups. Our first group was our real estate group. They looked at key industry trends and metrics to educate the client and investors, but most importantly, they broke these metrics up by the UN development goals specified by the client. They then looked at key building certifications such as LEED, WELL, and GRESB to match specific metrics to these UN development goals and also monetize them. Our second group was our cost-benefit analysis group. They took these monetized metrics and put them into the client's financial model to create a sustainability cost-benefit analysis. Our final group was our finance group. They looked at traditional investment strategies and impact funds to come up with the client's impact investing strategy. So our first deliverable was our sustainability metrics. As you can see, our group started by looking at the UN Sustainable Development Goals specified by our client. They then looked at a strategy for addressing each of those goals. Right here, I just have one per SDG, but for our client, we have several that we're providing for them. We then found the impact of each of those strategies, and then we monetized it in a cost per square foot so we could use it in our later deliverables. I'm going to walk us through one specific example right here. So our sustainable development goal is affordable clean energy. The strategy is energy efficient appliances. The impact is reduced greenhouse gas emissions, and we found that comes at a cost of 67 cents per square foot. So moving on to our cost-benefit analysis, they took those monetized metrics from our real estate group. They plugged them into the client's existing financial models. They then found the total cost of these sustainability add-ons, and this was done to a relative 500,000 square foot neighborhood-sized development, for an example. They mapped them into the monthly cash flows with the costs, benefits, and discount rates to calculate the net present value to determine the financial benefit and the sustainability benefit of each add-on. So again, walking us through one more example right here. We're back with our energy efficient appliances. We know that comes to a cost of 67 cents per square foot. The total project cost came to just over $380,000. The non-financial value was over 92 million pounds of carbon dioxide equivalent mitigated, and the net present value over a 20-year lifespan came to around $2.5 million, indicating this project not only has great sustainability impact, but financial impact as well. So our final group was our finance group, who created the client's impact investing strategy. In order to determine this strategy, they did some research in some key areas. The first was fund structure and fund deployment. We define fund structure as the type of capital that makes up the fund. So I would think of this as the loans, money from investors seeking returns, or grants creating that pool of capital. Our fund deployment structure is how that pool of capital gets invested into projects. So again, this money could be deployed as loans like you would think of from a bank, equity from investors, or even grants, and how this money gets invested into different projects across the real estate investment timeline. So we have our real estate construction timeline right here. You see there are 4 key phases: land acquisition, pre-development, construction, and post-construction. We then map the investment risk at each stage of the construction timeline. So in the beginning, you can see there's much higher levels of risk because projects have the chance of default. Maybe they lose funding, there's regulatory challenges, and they don't get completed. And then as you move on across our construction timeline, you can see there's lower levels of risk because the projects are completed or it's finally just maintenance. So based off of this research, our group advised the client to create a 2-fund impact investing strategy. So our first fund is a nonprofit fund. We recommend this is composed of a single asset class, so one type of capital structure. And given this is a nonprofit, this would be grants or philanthropic donations. We recommended a mixed deployment structure, so investing that money as loans, equity, to minimize the risk of the fund. And we recommend it's best invested in land acquisition and pre-development. As a nonprofit fund, it has more flexible risk and return timelines, so investing in these areas to create sustainability impact early on in the fund is crucial. Our second strategy is that for-profit fund. We recommend a for-profit fund because it can generate a much larger pool of capital, a lot more money to scale into some bigger projects. So we recommend this is that multi-asset class fund structure. So getting money from investors seeking returns, loans from banks, maybe grants again as well. We recommend a mixed deployment structure here as well, considering loans and equity just to minimize that risk across the investment. And then we recommend this fund is best invested in construction and post-construction stages, as these have much more predictable returns and profit timelines. And given this fund has to give money back to investors, that is key. Through this 2-fund strategy, we believe we can create impact, sustainable impact, across all stages of that construction timeline and really work to scale our mixed-use sustainable development. Moving on from our deliverables, we broke our action items up into our clients into short-term and long-term actions. In the short term, we recommend our client integrate those sustainability metrics into their existing financial models, launch with the nonprofit fund for increased flexibility, and find 2 to 3 projects and reverse engineer for the ideal financing. In the long term, we recommend Urban Reboot build trust with investors and industry experts, evolve into that blended capital fund over time to create larger and more scalable impact, partner with community development financial institutions, banks, local governments, and scale into new cities and geographies. I would like to thank you all for being here tonight. I'm now happy to open the floor to any questions.
I have a question regarding the sustainability thesis and how you're thinking about affordability and equity in the strategy.
Yeah, thank you for your question. That's definitely been a consideration of ours as well. In our report, this is something we dive into a little bit more, kind of talking about gentrification and educating our clients on the impacts of it. Affordable housing was out of the idea of the client scale for what they hope to achieve. But we recognize that it is important to kind of have that apartment structures with mixed classes, kind of. That is something the client's considering. And obviously in mixed use, there is several different development types, kind of considering that cultural aspect to recreational. So working to incorporate like a wide variety of communities into these sustainable developments is something important for the client as well.
Thank you for your presentation. I have a question with regards to the sustainability metrics that you have and the different kind of interventions. It does seem that the dollar value term is underpinned by certain assumptions on, let's say, the green spaces. Do you have any form of recommendations on how to improve the accuracy of such metrics?
Yeah, so we started by taking our metrics from key building industry certification standards such as LEED and WELL. What we did was we created also a threshold for each metric. So the best standard for the client to implement this or a developer to implement this. So by highlighting the threshold that we set in the report, that kind of creates the guidelines and the best implementation case for each of the metrics that we provide. It was a little bit deeper than I could get into in our presentation tonight, but that's definitely highlighted a bit more in our report too.